back to Firewall. I'm your host, Bradley Tusk. My guest today is someone who's been on a whole bunch, Jordan Knopf. Jordan is my partner at Tusk Venture Partners. And Jordan, welcome back.
Thanks for having me.
It's been a few months, I think, right?
Yeah.
So Jordan and I kind of always have the same rough agenda for these podcasts, which is a general kind of discussion of the state of the economy, technology, and venture capital, and then it just kind of veers in various directions. But let me just start with the most obvious question, which is VC is still not anywhere near where we want it to be. There's virtually no liquidity, very few IPOs, not much meaningful M&A. But if you look at the overall metrics of the economy, inflation is down, stock market is booming, crypto is rebounded. So why is the economy doing so well and that not translating into venture capital and tech startups?
So it's a great question. It's one that, probably is rooted in a few different answers, but primarily, look, private markets always lag the public markets. Mm-hmm. And so on the way down, it took a lot longer. The public markets were down materially before you really started to see valuations correct in the private markets. And on the way back up, it tends to do the same.
So the last cycle, when was the last time that VC kind of was in a prolonged slump like this?
There's been quite a few. So I'd say, post the global financial crisis,
yeah.
And then you're thinking in, post obviously the dot-com bubble, that right. was a large one. And then there's been kind of a prolonged bull market, I'd say, since, let's say the recovery coming out of the global financial crisis, where you saw unemployment decrease for the better part of 10 years as the economy continued to pick up steam more and more. Look, I think it was a lot slower on the rise up until COVID, and then you really started to see things explode.
Yeah, and I would argue we did a lot of this to ourselves, we meaning writ large venture capitalists. Now, it's a system that everyone would say, well, I just have to participate in the system as it is. But, we have so, in my view, overvalued private companies. And we know this because when they go to the public markets, they lose 70% of their value almost, in the first couple of months. That, to a certain extent, look, there's always going to be cycles of boom and bust, and that's just the way economies work. But I think also there was a level, keep in mind, my only, as you well know, exposure to VCs when you and I first started working on this in 2015. But there's a level of rapaciousness and greed that just seemed totally disconnected to reality from what I saw.
So it's interesting you just said that. So there is a trend that if you think back to 2015, 2016, a big criticism by some people, it felt like actually everybody was criticizing venture to some degree. You had people that were public market participants that were critical of venture capital in general, just because you had a lot of the value being created from, if you take the total equity value of a publicly traded company, a lot of that value is being captured by the private markets. Where if you were to look at that compared to 20 years earlier, where you started to see some of these really big names that would go out and raise, they would do an IPO at a much smaller size and created a lot more value in the public markets. So public market investors were, they were critical of staying private for as long as we were. And then, but also if you look at like right now in the market, no one's going public, but the public market has been pretty clear that not only do you need to be profitable, but you need to be at scale. You need to be doing top line revenue numbers that are far in excess of what they used to be.
And so what's that, like 250 million, 500 million? What
so it's come down, but so it used to be, $100 million and you could go public, particularly if you were profitable. Now it's, and you were still growing very quickly. Now, so just after let's call it 2022, that number shot up and it went to about 500. If you wanted to get north of a 10x multiple in the public markets. Yep. So now, I think that's probably a 300. I think that people would be really nervous going out with
300 and profitable.
300 million top line. I mean, the best, if ideally 300 million in top line revenue, you're growing, so your EBITDA margin is definitely double digits and improving, and you're growing year over year still.
So you're on boards of some very fast growing companies. And to a certain extent, you guys have to make decisions that toggle between growth and profitability. As you're thinking about companies moving towards an exit, how are you adjusting the dials?
So I think that it's just really interesting. Every investor probably has a different formula for this. The people that spend the vast majority of their time, so the growth investors at this stage, that's something that they think about a lot. So, I think that that's something that you always want to take to listen whenever those investors on your boards actually do chime in on that. I think that the toggle is between growth and profitability. So how much are you, what is the market rewarding you for in terms of incremental percentage growth versus what is the market rewarding you for incremental percentage in profitability? And you toggle based on that. So basically,
is it sort of a trailing indicator in the sense that you have a quarterly board meeting and you're thinking ahead to an IPO, and then there's a whole process in an S1, and then it finally goes public, and then the markets have to evaluate it, where part of what you're thinking about is like, okay, right now, there is more priority by the market on unit economics, or there's more priority by the market on growth metrics, or whatever it is, but you're really having to sort of predict where that is going to be in really the soonest 6 months, right?
So yes and no. So you're right in terms of what happens at the time whenever you go public, but the way that you're kind of landing the plane, let's use that metaphor, is that you're kind of doing what's in the best interest of the company in the next 12 months. So you're looking at, is this the best use of cash that's on the balance sheet? What does that look like? Is the market, am I acquiring new customers at lower than my typical acquisition cost or higher? Then that would be a strong case to scale back your marketing spend if you don't feel like, and that tends to happen, like the market tends to get saturated, you have competitors that come after your business, and a lot of people throwing money at the same AdWords or Facebook, whatever, if it's a consumer enterprise business. So I think that's the trade-off that you're going to have just on running the company. And if you just do what's in the best interest of all stockholders, including employees, at every point in time, that's typically how you should really be driving the.
So Dan Primack, our friend, wrote a column recently that was titled "Dear Venture Capitalists, You're Blowing It," and his basic argument is VCs won't take their companies public because the private valuations are too high. They know they're going to get cut materially, and then that's going to really decrease what they're able to return to investors based on what they're showing them in paper markups. And so in order to preserve this sort of cycle of really a lot of AUM and really high management fees, they're kicking the can down the road, and investors are getting sick of it, and they're moving away from VC entirely. Do you agree with him?
There's parts of it that I think are assumptions that aren't necessarily true. So I mean, first off, I would say, it's not me or it's not us collectively that is. Trust me, if we could get liquidity right now, we would. I'm not a majority owner in any of these companies. It's not my decision to make. I'm a minority investor representing our fund, and that means that I don't have any control.
You talk to the other board members,
and yeah, I talked to all the other board members, but there's competing economic dynamics there as well. So we're an early stage investor, so we're going to be more economically aligned with the founder than the growth investors who came in at a higher valuation. So they may want to be keeping the company private because they invested at a much higher price than we did, and typically you'd think that early stage investors and the founder would want to exit the company. So I think that's that is the case in a lot of dynamics. Matters really kind of.
So given how big rounds got, so you have your founder who kind of gets diluted, and it was hopefully at 10 to 15 by the time that the company goes public. You have your early stage investors, but oftentimes in an initial round, we're putting in a couple of $1 million, and then by the much later rounds, people are putting in arguably tens or even hundreds of millions of dollars, right? So therefore, their economic, everything gets weighted much more towards them. What's the balance of power like in the room when some growth fund that put 300 million in there, and you've put over the course of the whole process a total of 15 million or 20 million?
So I'd say that really the core. That's the core issue that you would have there, in theory, is the pref stack. So you have companies.
Just explain to listeners.
That is the preference. So the amount of preferred stock that's been issued that needs to be paid back in full before the common share has any value. So if you've raised 300 million, like in the example you just had, regardless of valuation, that if there's a down round or the exit is down, you're gonna need to clear the pref stack, meaning that you need to, before the company is worth a dime to common stockholders, you need to sell for at least $301 million, basically, and then that's the only way that you would actually accrue value to common stockholders. So the dynamic there becomes if the valuations pull back, we're still in the money as an early stage investor. So, let's say you invest at a 50 post or a 25 post or whatever you came in at, and then that company goes on to be worth $1, $2, $3 billion, you're good.
Right. I always say to people, if a company's going to IPO, we're going to make a lot of money.
It's you're going to be good. It's the problem's not back to keep with your example, 15 million that went in. It's clearing out the hundreds of million that came in later on at a much higher price. So what happens is, let's say that last round got done at a $1 billion or a $2 billion post. Let's just go with that. And so $1 billion post, they bring in 200 million of extra money. That investor, let's say that it was one investor that put in the 200, that investor is going to, if things stop working and the business does materially change, they're going to be vying for, how do I just get my money back? They're going to be much more inclined, because they, A, have not been invested in the company that long. B, they know they need to clear such a high bar, meaning that $2 billion post money, right, to make any sort of profit. They're just wanting to get their money back. And they can do that by pushing the company to shut it down, to return capital to investors. At least they could recoup some of the money that's still on the balance sheet, or to try and sell the company for a strategic.
And do you worry about a disparity in the market where, like, we had some companies that we exited, like Lemonade as an example, where great company, but we did exceedingly well in part just because of market enthusiasm that drove the share price luckily around the time that we were able to exit much higher than it is today. Right. And obviously, you say a lot, our job isn't to time the market, and it's really not what we're experts at all. But if the stock market is booming now, and then let's say the wave of big tech VC IPOs hits in 25, 26, don't you want the market to be at a sort of maximum enthusiastic in general to drive the valuation and the trading of your companies?
That's a really good question. So I think that the companies that people are enthusiastic about really do matter a lot, right? So the number where you see excitement in the market today is in very large name technology companies, but some smaller ones as well. And I think that those pockets have been driving, the excitement, and that a lot of that has to do with AI. A lot of that has to do with companies that have benefited from the AI boom that are not maybe necessarily AI, like cybersecurity. You've seen a lot of those companies really, really do quite well. And I think that is just because the public markets in general, I guess, are doing well, doesn't necessarily mean that what will be a small cap company, which was an IPO at, let's say that typical exit for us, or a mid cap company at best, they're not necessarily going to be doing that great. And so I think that you move away from macro tailwinds and how the market overall is doing, and you're reporting quarterly earnings and people care, that's fine, but how is this company doing? And I think that a lot of that comes down to, if there's enough sell-side research analyst coverage and a lot where you can educate the market. And I think that a lot of it comes down to the performance that a company has post-IPO.
Yeah. So let's take out your crystal ball, and I'm going to ask you what happens to venture if, and then I'm going to throw various scenarios at you. So the first one is, what happens to venture if Trump wins?
This is the question I go to you for. So what happens to venture if Trump wins?
So, it's funny because we sent out a letter to our LPs last week where I wrote a couple of pages specifically about really not even so much what happens if Trump wins versus Biden wins, but more making the case that when it comes to at least our fund, the regulation that really matters is state and local, not federal. So the federal government matters a lot around how they regulate. The SEC is going to regulate crypto. That might be much better in a Trump administration than it is in a Biden administration. We're not huge crypto investors. We have some exposure, but not a ton. FDA and biotech, we're not biotech investors. Military purchase of defense tech weapons, again, we're not big DoD people. So most of the stuff that we invest in, and the vast majority of consumer tech and even B2B tech that is regulated at state and local level. So I would argue, I don't think from a regulatory standpoint, there's going to be a huge impact on Trump. And if Trump were to win, other than maybe you can't have a more anti-crypto SEC chairman than Gary Gensler, so that should improve. And arguably, if you think that Lena Khan is wrong in her M&A views at the FTC, and I think you and I have slightly different views about her and her posture, but that would theoretically improve too. But I kind of mean more from a macro environment. If the world feels like, you could say Trump wins, people will feel better about the economy because they just do when Republicans are in charge, and that's good, or people will feel super anxious because Trump's a fucking chaos agent and they're just generally going to want to be much more conservative with things, which is not great for VC. So just given the almost the overall ethos of Trump, like, would your guess be that that's better for our investments or worse?
It's a great question. I think that it would really have to go. So I think one of the biggest things that you just said there was the FTC. So if you for venture, I'm just going to say what's in the best interest of venture is liquidity, right? Like, and that's going to be a major source of that comes from strategic M&A, and right now that market has been completely frozen. So whether it is Lena Khan's fault or people think it's Lena Khan's fault, it becomes a self-fulfilling prophecy, right. And people just don't want to spend time on doing deals that are not going to happen. So I think that's a huge, some certainty around her not being there or her being there is a pretty big deal, at least from a headline perspective. Then I think that
that's the funny thing is most of the staff is the staff.
Totally.
Right? Yeah.
Yeah. So it's I think that from a headline perspective, but also, look, and more specifically, I think it is it's the concern that has been really, people get really up in arms about is around her specific focus on being from an anti-M&A perspective in general, but more specifically, it's around big tech. So, a lot of companies exit to larger technology companies. If you limit that scope and say the biggest players in the tech ecosystem can no longer acquire businesses, it becomes really hard to find that right strategic fit for other portfolio companies. And it creates a less competitive pricing in the market. So our exits tend to not be as large. Right. So it's that's one aspect of it. I think that also the broad-based market is going to have an opinion on who's going to win or who they think is going to win based on just like typical policies that they believe will happen around taxes, around what's going to happen with unemployment, what's going to happen with basically to businesses that are doing business with China. There's a lot of things for the market to digest, but they've already done that before. So reapplying a better macro landscape to that, to what there is today, I think would be helpful. Now, I don't know what that would do in terms of earlier stage. That's with regards to exits. Obviously, if it's a lower interest rate environment, if the economy continues if they can get inflation under control, keep unemployment where it is today, or if the labor market continues to get a little bit tighter, that's not the end of the world. I think that the labor market actually. So if it's harder to get jobs, but it's easier to hire people. So it becomes a little bit looser, I guess, from that perspective. Yeah. But I think that's something that'll get priced in before the election even happens.
So on interest rates, we spend a lot of time saying to ourselves, once the Fed cuts rates, then you're really going to see liquidity improve and the IPO market boom and everything else. Are we overly reliant on the sort of belief in interest rates, or do you think they really are that big of a determinant in at least how venture liquidity happens?
I think they really are. I mean, venture liquidity is one thing, but also I would say just the ability to generate value in the private markets, and how the multiple that's being ascribed to any revenue generated from a private business. So every dollar of incremental revenue or future profits, you're going to say, I need more of it whenever interest rates are higher, because you're competing with what in essence is a free loan to the government. Or a guaranteed loan to the government.
Right.
So everything is kind of what's the return I'm going to get in excess of cash, and that just makes what you're willing to lock up for a very long period of time. You're just not going to be willing to part with your money with that much uncertainty.
Right. So there were all these assumptions that this year the Fed would cut interest rates 4, 5, 6 times. So far, they haven't cut it at all, and Powell even indicated that a rate hike is not totally out of the question. What do you think is going to happen? And when you're trying to answer the age-old question of like, When does the venture market open back up again? How much does that impact your thinking?
So I think that a lot of it's interesting because you have a lot of it is it starts with LPs, so limited partners, people that invest in venture capital firms, and their willingness to invest in venture capital funds that then will make investments into companies. A lot of people are sitting on a lot of dry powder, so I don't want to get overly focused on the limited partner side, but I do think just there's things that need to happen before that are important to the venture market in addition to just the liquidity happening. So I think that companies have been terrified to go out and raise new rounds of financing because it's been very slow in the market. So companies have it's not the end of the world that they've become more efficient and they've been able to stretch their dollars longer. And they've been done anything they can to delay raising rounds of financing. We need that to come back. We need people to actually go out and look to raise capital and to really fuel some of the businesses that are working to turn the dial back up on growth. So right now we've seen a material slowback in marketing budgets, and the businesses are just growing slower now, which is okay. They're doing it efficiently. It's not growth at all costs anymore. I just think that in turn with what people associate with a bull venture market is many rounds of financing occurring in very quick fashion, and ultimately an exit, and really the ability to dump as much money as possible on a very fast growing company, but being able to capitalize on that. So I think that part is, seeing the activity and the number of deals that are happening, but also new companies that are being formed. So, there are new companies being formed, but nothing like there was in the past.
Right. So, there's a lot of faith and excitement about AI, obviously, in both the public and private markets, right? NVIDIA now is, one of the 7 most valuable companies, and sort of, and then in the private markets, we clearly see a distinction in valuation for AI companies compared to everybody else. But it's still more promise, in my opinion, than actual progress, right? So there's ChatGPT, which I gotta say, maybe I'm the outlier here. I don't think it's that great. Like, it's fine. Every time that I ask it to do something complicated, it can't do it. Like, I was curious, like, what would the NFL schedule look like if there was a game every day of the week, and how would you factor in time for rest and stadiums and travel and injury, all the other stuff? Like, it couldn't do it. It just refused. And I feel like that every time I have something like that, it never has the answer. So does the AI boom just continue indefinitely no matter what? Or is there some point where a true product has to be out there in the marketplace that just blows everyone away?
I mean, look, I think that you are probably an outlier with that on the ChatGPT side. I think that a lot of people view that as, probably the hottest thing in technology right now.
I think it is. I just find personally that I'm not that impressed with it.
Yeah, I mean, I feel like that your questions are probably a little bit more of I'm going to try and break ChatGPT versus not like what people typically are using it for. They're like they want a summary of, and there are some great applications that have happened out of it. Look, I don't want to take away too much from what they're able to do, but I don't think
it's fine. So let's just accept that search is great. Sure.
Yeah.
What else has to happen for this boom to continue, or does anything have to happen?
Yeah, I think that there's quite a few. Right now, there's a lot of uncertainty around where value is going to be created in terms of the level, like where are you investing in the I don't want to call it the technology stack, but are you investing at the chips level? Are you investing in large language models? Are you investing in top layer applications that kind of augment?
And what do you think? I mean, obviously, this is a question that we'll debate today in investment committee, like we do every single Monday. But more broadly, when you talk to other VCs, between the chip level, the LM level, and the app level, where do you think most people are leaning?
So I think that there's the chip level. I mean, I only speak to other private market investors, really, so that's kind of out of the question there. But that's kind of been this obvious trade that's been going on with NVIDIA and so on. I think that there's a lot of uncertainty around the value that's going to be created in large language models, primarily because open source versus closed network approach, and so you really have some very large incumbents that want there not to be value created at the LLM level, and so that's kind of up for debate right now. And I think that everybody's view is mixed on the final, like let's call that the application layer, where there's specific companies that are built to solve specific problems within any industry that will capitalize on what doesn't really matter what LLM it's being built on. So let's say they're marrying a small language model with an LLM.
Right.
And so there's a lot of applications that we're seeing there that have not gotten as much traction as you would expect.
Yeah.
And some of them have. And I think that everything has just fetched a really high multiple because it's on nothing. None of them have been able to monetize on anything yet.
Right. Right. So, right. Some ways it's like NBA general managers love having endless draft picks because then it's always the potential of what could be as opposed to being accountable for what is.
That's right. And so look, I think that you can't sit on the sidelines forever here as an investor, but it starts to become kind of unfathomable whenever you're seeing checks being written for as large as they are. I do think there are some winners that have occurred that outside of the consultants that are advising the big companies on what to do. Those are the obvious winners here, but it's yeah, absolutely. But then there are companies that have benefited from the proliferation of pretty basic AI, which is not being used for nefarious activities. So cybersecurity companies in particular have really been on the tear here.
Yeah.
So
it's interesting, right? So like I would just I've been thinking about this also from a regulatory standpoint, and I think the right place for most of the regulations is at the LLM model. And I think the EU, when they issued their initial framework last December, did a good job at seeing that. But the way that politics works is a politician hears about something, usually in the media, is outraged, realize if they jump on this thing, they'll get a bunch of attention, and then they introduce legislation immediately to deal with this thing. And that's always going to come at the application level, right? Because it's going to be some app that can do something that all of a sudden is seen as, way too deep state surveillance or invasion of privacy around using people's voices or whatever it is. So they're always going to want to regulate it at the app level. But the reality is it's really more about whether the underlying technology is being built or not to allow, the market is the market, right? Some app developers will say, okay, I'm not going to build that app because I don't think it'll ultimately survive the regulatory process, or I'll get too much public criticism or whatever else. But the market the vacuum is always filled, the void is always filled, right? So like whatever you can do that's both good and nefarious with any piece of technology is going to be done. And so I don't know, there's no answer to this yet, but it'll be curious to see where the investment answer is to sort of the LLM versus application level compared to the regulatory over like the next 10 years or something like that.
Yeah, I think that there's a few different examples where, if you think about back to the let's call them the social networking companies, where the value was created and capitalized on by early stage investors a long time ago. And now is like we're finally seeing kind of the tail end of like a lot. What were the implications of this happening? What was the implication of social media not being regulated for as long as it was? Where did we get the age right, where we were letting people join Facebook or Instagram or Twitter or what doesn't really matter, the enforcement element of it, which was non-existent. And I think that now we're finally starting to see that. But the issue is that it's really hard to figure out, like, are we observing and testing something enough or for long enough to make the right call? And I think that you start to get people calling, like with crypto, people really wanted clarity around it and they got it. And they finally got, I think now the market is showing that there's a lot of certainty around where the regulation is going with crypto. And that's been part of the reason for the recent drive up in some prices. But I think that it took us a really long time to get there.
Yeah.
So with AI, I think that people are looking at it and saying the implications of this are going to be huge, the economic implications and the implications this will have on the way that children get an education, the way that people do work, the way that, people that jobs, there's a lot of change, which is going to be really uncomfortable for everybody involved. And regulators are right to want to get in front of that. The problem is that you have every state, as you obviously are tracking, the number of
over
bills.
200 bills were introduced this session at the state level around AI. And, this is where I think I just keep trying to explain this to founders and to LPs that everyone always focuses on Washington. And yes, in the 1 in a million times where Washington can actually manage to get a bill all the way through Congress that can preempt all local regulation, sure. But it's so few and far between that the vast majority of it is happening and will happen primarily at the state level. You could see some at the local level too, municipal. And it's a little crazy because most of the people who are voting on these bills and evaluating these bills don't know anything about AI whatsoever. And so you actually just saw in Connecticut, there was a really big AI regulatory bill that Governor Lamont said he would veto, and that killed the bill. There's a bill that passed in Colorado last week, I think, that Governor Polis has not said what he's going to do on it or not, but I think there's a lot of thinking that he might veto it because, if you're an individual legislator, you're just trying to solve whatever particular small problem you think you're getting at with your ban. But to the extent that you're a thoughtful governor, and I would say Lamont and Polis are both thoughtful governors, you recognize that whatever you're going to do is both then set the direction for the development of AI in your state and your state's economy, and also the impact on other states and therefore effectively national AI policy. And I think they're in this like, holy shit, we really don't know what we don't know moment yet.
Yeah, I don't think anybody knows what they don't know. I mean, everybody is kind of in this, we're still in such a rapid discovery phase right now. There's like a lot of uncertainty around how this is going to evolve. I think that we're so far into the early innings here. The AI as we know it today is not really that complex compared to what everybody's working towards. And so I think that moment is kind of probably where the regulation should be focused on. I just don't know if at the state level that is ever going to work.
Yeah. So in the last month, biotech and healthcare got 26% of all funding. And obviously we're not biotech investors, but we have invested very heavily in digital health. And you sit on a bunch of boards of digital health companies. What's your sense of where the sector is going, how usage is, and kind of where it was during COVID compared to now that we're clearly in the post-COVID period?
Yeah, so I think that if you were to double click on those numbers, you'll see that that's skewing very heavily towards biotech. Yeah. That's an area of tremendous excitement and use case applications in healthcare in general. So let's just, even if we lump it all in for AI, in the drug discovery process, in a lot of if you want to talk about the use of digesting a lot of large data sets, you're not going to find better case than in healthcare. But I do think you need to bifurcate out like the biotech side or the drug discovery or even broader scientific discovery and money.
And some of that also fueled by AI in the sense of
absolutely,
like drug formation to me is the most promising corner of AI.
Yeah, so it's a drug formation, but it's also a lot of the research that's done ahead of that, and let's call that gene therapy and a lot of things that are really advanced from a scientific perspective. And I think that people are really excited about the ability to run much faster at some of those research initiatives. So that's one piece. I would say that from healthcare, in the healthcare industry overall, so let's just say healthcare IT, maybe not specifically digital health, but I think that we've seen a tremendous change in the way that people are not necessarily engaging with providers. I think that behavioral health was a big winner there. I don't think anyone's going to refute that. Yeah. And then obviously the ability to, and this is partially behavioral, but to provide and partially general, where you're able just to provide access to basic healthcare services to much more rural populations in the U.S. Those were huge beneficiaries of this as well. But I think that obviously there was a huge pullback in the market of utilization over Zoom versus in person. And I think that though, where the universe where there's no hospitals or there's no doctor's offices, that's probably not there. Yeah. But I think that from there's been, from a spend perspective, a good amount of, a lot of companies are, especially the later stage ones and larger hospital systems and so on, they're all using AI to some degree. Whether that is a note-taking tool, whether that is, which we've seen a lot of that happen in terms of leveraging AI to basically make doctors more efficient, to save time but that's a pretty low stakes bar. Yeah. That's not anything close to drug discovery, let's put it that way.
So we're 14 months now out from the collapse of Silicon Valley Bank. We obviously lived it in very, very real time. I remember there was a moment where I was meeting Hugo's friend Mark Bittman for lunch, and I'm standing outside the restaurant. It was that like really good Singaporean place on 20th Street, and we already discussed about that our money was at SVB, but you were telling me all of the portfolio companies' money who was at SVB, which basically, if it all literally evaporated and wasn't provided, reimbursed by the federal government, could have shut down our fund entirely. So there was the horror of that. Then everything kind of worked out in the sense that at the very least everyone got their money back. But now that we're 14 months later, have there been lessons learned? Have you seen changes in the way that banking is done, or are we just going to go right back into what was?
Yeah, I think that there's definitely lessons learned. I think that creating the need for redundancies, I think, is not a lesson that anyone needs to learn twice. So I think that a lot of portfolio companies, that did not have a second banking partner have done that. Now, that's not, as we've seen post Silicon Valley Bank. If that went faster, then it took to unfold with First Republic, and then SVB was not the only domino to fall. Yeah, totally. And so it's that you can diversify out your regional banking partners to a degree, and then it just becomes not. If all of them go out of business much faster than they did, that would be very problematic. I think that it actually created, like zooming out, there's actually created at least an entry point that was logical for some of the other competitors of Silicon Valley Bank to come in and try and take market share away from SVB. So you saw unfortunately, First Republic was one of the biggest competitors of Silicon Valley Bank, so that's no longer up for grabs. But I will say there's been some other regional players that have definitely stepped up in their willingness to take on and their appetite to go and directly try and take business away from SVB.
So for listeners who are actually thinking like, okay, I need more banking options, which ones would you think they should check out?
Oh, I think that changes based on your needs. So some of them are going to be basic banking partners, and some of them are going to be much more willing to providing debt, which is what a lot of venture firms or a lot of portfolio companies are interested in. And some of them have much higher standards. So for lending, meaning they're not gonna really provide financing to smaller startups, but some of them will.
Yeah, and look, venture debt is certainly part of the playbook that we use.
Yeah, so I think it did get a little bit out of hand there for a bit, but and also SVB is still operating, and obviously they're under First Citizens, I believe is the name, but it's they still service a lot of portfolio companies. They still provide a lot of venture firms with banking services as well. So I don't think they're definitely I wouldn't count them down and out. Let's say that.
Got it. How come nobody talks about the metaverse anymore?
That's a great question. The metaverse in the whole 3D realm,
there was this moment where, and I feel really good about the fact that we were generally pretty resistant to it and only made maybe one or two dumb investments in the space, in kind of Web3, where it was like the rage, and that was where everything was going, and everyone had to be in Web3, and then it just fucking evaporated. Like, I haven't been pitched a Web3 company in months and months.
I would say that's probably going to come back.
What explains these? Even if we just use the metaverse as an example, what explains these trends where all of a sudden we're being? Because in some ways we're really good consumers of data in that we're being pitched all day long, right? And while we, to a certain extent, choose who's going to pitch us, we're also, to a certain extent, just seeing what's in the market. And so what we're being pitched, now I know that our regulatory focus skews it a little bit, but overall it should be reflective of where Founders is and where the market is. When you see these big shifts where all of a sudden everyone is on this thing or no one's on this thing, like what causes that?
So I think that it's really interesting because I think there's trends that are obvious that happen in the venture capital ecosystem where you have the opportunist founder that doesn't necessarily have a passion for building something in the space, but they see that healthcare or real estate or whatever the application is getting a lot of attention and a lot of funding, and then they're going to go and they want to capitalize on that. Then I think there's this whole other dynamic, and that's in the crypto market, which appears to be much more resilient than anything else that's out there. And I think that's basically, look, I'm sure there's a bunch of reasons, but I do think that the behavioral pattern of a get rich quick scheme is always going to be a draw for people. And I think that that's where this like Web3, NFT, and the various, like, we're not just talking about Bitcoin and Ethereum anymore, like where we're talking about pretty complex and hard to evaluate technical protocols that people really have a hard time wrapping their head around, but they still want to invest in it. And I think that market is just proven time and time again to be more resilient than anyone wants to give it credit for. And that fuels a lot of the Web3 excitement.
All right, so last question. It feels like New York City is doing pretty well from a tech standpoint, right? And it feels like San Francisco has sort of lost a lot to Austin and Miami, and New York less so. There are like on the more hedge fund side, investment bank side, people who've moved to West Palm Beach, whatever. But I haven't really seen all that materially on the tech side. You've been living in New York now for the last 20, 25 years or something like that.
Close to 20, yeah.
Yeah, and you've always been a big booster of the city. Do you think that there's something kind of indelible about New York City that just makes it a good place for founders and for VCs, or do you think that this is all at risk?
No, I think that New York is, I feel like I've been very vocal about this for a very long time, that New York provides a very unique and special place for people that are very ambitious and curious and really just want to build an amazing company. It gives them, access to other people that are equally very ambitious and very smart and basically, whether that's in media, whether that's in finance, and access to all of these people is what really fuels this like special ecosystem here. I will also say that the access to talent, which is critical, is New York is about as strong as it's ever been.
Yeah. I remember, Hugo, you sent me a chart last week that showed that college graduates overwhelmingly pick New York over everywhere else as to where they want to be.
They finally come to their senses. It's also, you have this city that has so much to offer, and it was really fascinating whenever a lot of companies were still in the hybrid environment and people were still just wanted to move to the city, not because they needed to be here for work. A lot of them were basically on Zoom all day, but they're in their apartments because it's just such a great place to live.
Yeah.
And so, it's been great. And I think that San Francisco has been, in its own.
When was the last time you were there?
Oh man, I was actually thinking about this the other day. So it's been 2 years.
I haven't been since COVID.
No, so I was there a year and a half ago, I guess. But I've been to LA multiple times.
Sure,
going to LA next week. Yeah.
It's, raise money next week.
Which is very bizarre compared to. I never thought that going to California without stopping by San Francisco.
Yeah.
That would just never happen.
Yeah, it's amazing.
Yeah.
So, all right, Jordan, thank you as always, and hopefully come back a couple months and we'll do it again.
All right, it's been fun.
Firewall is recorded in my bookstore, P&T Knitwear, located at 180 Orchard Street on the Lower East Side of Manhattan. We'd love to hear from you with questions, feedbacks, or idea for a guest. Just email me at bradley@firewall.media or find me on LinkedIn. And to keep up with what's on my mind and my latest writing, please follow my new Substack at bradleytusk.substack.com. Thanks again for listening.